Someone just placed one of the most extreme bets ever recorded in the gold options market. Not a small hedge. 11,000 contracts, deep out of the money, targeting $20,000 gold by December. Gold is sitting near $5,000 right now. That means this trade only pays off if gold triples inside of 12 months. And the person who made it isn't panicking. They're calm, calculated, and fully loaded. But the gold bet is only half the story. While everyone was staring at gold charts, the US government quietly did something with silver that has never happened before in the modern era. Something that changes the entire supply equation for one of the most industrially critical metals on the planet. When you connect these two events, the $20,000 gold calls and the silver move, the picture that emerges is not comfortable. Stay with me, because by the end of this, you'll understand what Wall Street and Washington are both silently preparing for. Let's start with the gold trade, because the structure tells you everything. This isn't some random speculator throwing darts. It's an institutional grade position built on a specific thesis. The trade is a call spread, buying the right to profit above $15,000 gold and capping the gain at $20,000. That cap isn't pessimism, it's cost efficiency, designed to maximize asymmetric exposure at minimal premium. Gold futures recently settled near $4,199 after a brutal crash from $500–600. The drop was violent, fast, and structural, not random noise. On January 30th, the market got news that Kevin Warsh would be nominated as the next Federal Reserve Chair. Warsh is a known monetary hawk, and that single headline destroyed months of carefully built gold positioning overnight. Managed money longs on COMEX dropped by over 17,000 contracts in a single week. Silver ETF holdings fell for 7 consecutive sessions to multi-month lows. Speculators didn't exit slowly. They were forced out through margin calls and panic liquidation. Positions built across months were gone in hours. And then, right after all of that carnage, someone started quietly building those 11,000 contracts in deep, out-of-the-money calls. That's not a retail investor. Retail doesn't build positions like that in the options market after a crash. That is institutional money with a very specific macro thesis. And the thesis isn't gold goes up a little. It's gold goes up 300%. Now, before you dismiss that as impossible, consider this. Gold has already more than doubled since early 2024. The same people who would have laughed at $5,000 gold 2 years ago are watching it happen in real time. Gold hit $5,600 this year, an all-time record. The question was never whether gold could make extreme moves. The question is how far the next leg goes. To understand why that $20,000 call spread isn't irrational, you need to understand what's happening with US debt. The national debt just crossed $38.43 trillion and is growing at roughly $8 billion per day. Annual interest payments are about to breach $1 trillion for the first time in U.S. history. The Congressional Budget Office confirmed that interest expense is now the single fastest growing line item in the federal budget, outpacing Social Security, Medicare, and defense combined. At some point, that math stops working at market interest rates, and that's exactly where the most critical piece of this puzzle comes in. Kevin Warsh, the very man whose nomination crashed gold, has now confirmed that the Federal Reserve will coordinate with the U.S. Treasury to run yield curve control. Yield curve control means the Fed artificially caps interest rates on government bonds regardless of market demand. The last time the United States ran this policy was during and immediately after World War II. We are talking about a wartime monetary tool being deployed in peacetime because the debt load is that extreme. In plain language, this means the government is admitting it cannot service its debt at honest market interest rates. So it will force rates down, print money to buy bonds, and deliberately allow inflation to erode the real value of what it owes. That is the most bullish possible environment for gold, not for a few months, but for years. Real interest rates go deeply negative, the purchasing power of the dollar declines by design, and there is no market mechanism to stop it because the Fed itself becomes the mechanism. That's what those 11,000 contracts understand. They're not betting on a chart pattern or a technical breakout. They're betting on the endgame of a debt crisis that has no other resolution. Morgan Stanley's chief economist noted that one person doesn't change an institution overnight. Even worse, stepping into the chair won't materially alter the Fed's near-term path. The debt is so enormous and the interest burden so crushing that financial repression is the only realistic playbook. Inflate, suppress, print, repeat until the debt shrinks as a percentage of economic output. That's the game, and gold is the most direct hedge against exactly that game. Central banks around the world already understand this. In 2025, over 22 central banks increased their gold reserves, buying more than 1,000 tons in total. Poland bought 102 tons for explicitly stated national security reasons. China bought gold for 15 consecutive months. And here's the detail that should stop you cold. More than half of all central bank gold purchases last year were unreported, secret acquisitions that governments didn't announce. Governments are buying gold and not telling anyone. When the institutions that print and manage currency start secretly accumulating the one asset that exists outside the currency system, that tells you something about what they privately believe is coming. The implied volatility on far out-of-the-money gold calls has surged across the entire options chain. The market is pricing in the possibility of extreme parabolic moves. Not 10%, not 20%, but the kind of moves that happen when confidence in a monetary system fractures. Realized volatility is also elevated in the aftermath of January's crash. The options market isn't calming down, it's coiling, reflecting a market that expects another major move, but isn't sure yet exactly when. But here's the thing about direction. Every single structural force points one way. Debt, deficit, yield curve control, central bank buying, dollar debasement, they all push gold higher, not lower. So when I see 11,000 contracts betting on $20,000 gold by December, I don't see madness. I see someone who has done the math that most people are deliberately avoiding. Now, let's talk about silver, because if the gold trade is a calculated institutional bet, the silver story is something else entirely. It's a structural disruption that changes this market permanently. In November 2025, the U.S. Geological Survey finalized its annual critical minerals list and added 10 new entries. For the first time in the modern history of the United States, silver was among them. Silver is now officially classified as a critical mineral, alongside lithium, cobalt, uranium, and rare earth elements. This is not symbolic language. This is a legal designation with real, enforceable consequences. Critical mineral classification mandates accelerated permitting for domestic production, triggers federal subsidies and tax incentives for mining and refining, and most importantly, legally activates strategic stockpiling protocols. The government doesn't just get the option to stockpile silver, it gets the obligation. The Defense Logistics Agency manages the National Defense Stockpile. Congress appropriated $2 billion to expand that stockpile, and the Department of Defense has already announced intent to procure up to $1 billion in stockpile materials. Silver is now on that list. A buyer just entered the silver market that wasn't there before, one with essentially unlimited purchasing power and a congressional mandate to buy. But it gets more complicated and more urgent because of what China is doing simultaneously. As of January 1st, 2026, China officially added silver to its rare earth minerals export control protocols. China controls approximately 70% of global refined silver supply. 70%. And they just told the world they're restricting how much of it leaves their borders. So you have two superpowers moving on the same metal at the same time, in opposite directions. The United States saying we need to stockpile silver, and China saying we're keeping ours. One analyst described this as a strategic world war. Not with bullets, but with metals. When you look at what silver actually does in the 21st century economy, you understand immediately why both governments are treating it like a weapon. Silver is inside every solar panel, every electric vehicle battery connection, every semiconductor powering AI infrastructure, every piece of military electronics, every 5G antenna, every advanced medical device. It is irreplaceable in all of them. Not optional, not substitutable, irreplaceable, and the supply is already critically thin. The Shanghai Futures Exchange silver inventory has dropped to just 11 million ounces, an alarmingly fragile buffer for one of the world's most important industrial exchanges. COMEX registered silver recently broke below 100 million ounces. These are multi-year lows in the warehouses that are supposed to back paper contracts, totaling many times that amount. Silver lease rates recently spiked above 6% before easing back toward 3%. A 3% one-month lease rate is still more than 3 times normal. It tells you that physical metal is genuinely difficult to locate and borrow. When you have to pay 3% to borrow metal for 30 days, supply is stressed. That's not a paper signal. That's the physical market sending a distress flare. The January crash taught the entire industry a terrifying lesson about what happens when silver moves too fast. As silver ran from roughly $20 to $121, the physical supply chain began seizing up. Refiners froze first. The margin calls on their hedging positions became unmanageable as exchange margin requirements kept climbing with the price. They stopped accepting raw silver and shut their doors. Coin dealers couldn't source metal from frozen refiners. Wholesalers ran out of capital to maintain inventory. The physical supply chain didn't fail because silver didn't exist. It failed because the financial infrastructure wasn't built to handle that velocity of price movement. The system broke at $121, and it won't be stronger at $200 or $300. It will be more fragile because the lesson every participant learned is to hedge earlier, use less leverage, and pull back the instant volatility spikes. The January crash was brutal for silver holders, dropping from $121 to $64 in a single session, a 47% collapse in hours. Technical analysts declared it a blow-off top, a generational peak, the end of the bull run. I want to explain precisely why I think they're wrong. Silver went up over 140% across 2025, then added another 70% in January alone. Any asset that gains 70% in 30 days will correct violently, regardless of what it is. A violent correction after a parabolic move is not evidence of a structural top. It's evidence of leverage being flushed, which is precisely what happened. The indicator that matters most in distinguishing a correction from a reversal is the mining shares. In true blow-off tops, miners collapse harder and faster than the metal. They lead the way down. That didn't happen in January. Silver mining stocks dropped roughly half as much as the metal itself during the crash. Miners holding while the metal corrects has been one of the most reliable signals across 3 previous precious metals bull markets. This is a shakeout, not an ending. The underlying demand drivers have not changed by a single percentage point. Silver is in its 5th consecutive year of global supply deficit, demand outpacing production for half a decade. And the demand is bifurcated, which is what makes it so relentless. Industrial demand from solar, EVs, semiconductors, and defense doesn't slow in a recession. It's policy mandated and infrastructure driven. Investment demand accelerates as confidence in paper systems declines. 2 separate demand pools, 1 constrained supply, and now a 3rd buyer, the US government, entering the market for the first time ever. That is the setup. The big banks are beginning to reflect this shift in their positioning. Credible reports indicate that JP Morgan has moved its metals desk to Singapore and is financing the Department of Defense's new critical mineral smelting facility. The COT data shows the 5 largest U.S. banks collectively shifting their silver futures, positioning toward net long. The direction of the visible change is clear, even if the full derivatives book remains hidden. Banks don't move toward net long on silver because they think prices are going lower. When the same institutions that have historically anchored the short side start quietly accumulating, the market is telling you something important. Now here's the connection that ties the entire thesis together. If gold goes to $15,000 or $20,000, which is what those 11,000 contracts are betting, silver does not stay at $77. The gold-to-silver ratio historically compresses violently during the final acceleration phase of precious metals bull markets. At the historical average ratio of 40 to 50 to 1, with gold at $15,000, silver trades between $300 and $375. At $20,000 gold and a ratio of 40, silver sits at $500. You're currently getting it at $77, 37% below its all-time high, during a supply deficit, with government stockpiling incoming and Chinese exports restricted. That gap between current price and fundamental value is what makes this arguably the most asymmetric trade in any market right now. You don't need everything to go right. You just need the macro trend to continue. And there are additional structural tailwinds that most commentators haven't priced in yet. Starting February 1st, 2026, 401k programs and defined benefit plans from large corporations are now allowed to include gold and silver as investment options. They're not required to, but allowed to. And as employees see headlines about critical minerals, government stockpiling, and record gold prices, even a small allocation shift represents enormous demand against a market this small. Wall Street itself is quietly rewriting the portfolio allocation model. The traditional 60-40 stock-bond split is giving way to a new framework: 60% equities, 20% bonds, 20% gold. If 20% of institutional assets rotates toward gold, the overflow into silver is not optional. It's mechanical. Every major gold bull market in history has pulled silver along, and silver's move is always more explosive because the market is a fraction of the size. There's also a geopolitical wildcard that nobody in mainstream finance is pricing into their models. The situation with Iran is not resolved. It is escalating. If a major military conflict erupts in the Middle East involving the United States and Iran, gold goes limit up instantly, and silver follows. War doesn't reduce the need for semiconductors or military electronics that require silver, it accelerates it. Even in the worst-case geopolitical scenario, silver demand doesn't decrease. It accelerates from both the safe haven side and the industrial side simultaneously. There's one more dynamic that is profoundly underappreciated by most market observers. The battle between physical and paper price discovery in silver is not settled. It's ongoing. For several months in late 2025 and early 2026, the physical market briefly took control of price discovery from the paper market. Chinese industrial buyers on the Shanghai Metals Exchange were setting the price based on real metal demand, not futures contracts. Then the crash restored paper market dominance. Banks that were net short tens of millions of ounces got the price back to levels that cleaned up their monthly reporting. Both major corrections in silver, December and January, happened right at month end. That timing is not coincidence. It's the paper market defending its positions at reporting dates. But winning the monthly battle is not winning the war. Every month that passes without the supply deficit being resolved, every month that Shanghai inventory stays near 11 million ounces, the paper market's grip on pricing weakens. At some point, the physical market takes control again, permanently. And when it does, the moves will not be 70% in a month. They will be something that makes 70% look modest. Let me be direct about what I believe the complete picture adds up to. The $20,000 gold bet represents institutional money that has done the debt math, understands yield curve control, and is positioning for the end game of a 40-year fiat experiment that has run out of honest options. The silver critical mineral designation represents the U.S. government publicly admitting what the DoD has privately known for years, that silver is a national security asset, that China's control is a vulnerability, and that the United States needs to secure stockpiles before competition intensifies further. The January crash was not a top. It was the most violent and efficient shakeout in decades, flushing weak hands and leveraged positions before the next structural leg begins. Every fiat currency that has ever faced this level of debt relative to economic output has eventually been debased. This is not a political argument. It's a historical observation with zero exceptions on record. And you are watching it happen in real time, with the data visible to anyone willing to look past the surface. COMEX inventory levels, lease rates, QOT positioning shifts, yield curve control confirmation, critical mineral designations. None of this is hidden. What's hidden is the willingness to connect the dots, follow the logic to its conclusion, and understand that the story being told is not gold might go up a bit. The story is a fundamental repricing of what safety means in a world where the risk-free asset is the thing being deliberately devalued. This is not financial advice. Do your own research, consult professionals, and make your own decisions based on your own situation. But the data is the data, and right now it's pointing somewhere very specific. 11,000 contracts on $20,000 gold, critical mineral designation for silver, $2 billion in stockpile funding, China restricting exports, Shanghai inventory near historic lows, yield curve control confirmed, miners holding through the correction, supply deficit entering year 5.